The Rebel Capitalist Show. First thing I wanted to discuss is a rather esoteric item that I've really only heard Snyder talk about, and that's the inversion of the Eurodollar future curve.
Yeah.
And I heard you talk about that the other day. So I wanted to get your view on, is this something we should be looking at? What are the predictive abilities? Or is it just something that's kind of noise?
Well, if you look at history, this is basically one of the best signals that we have in financial markets in terms of what's upcoming when it comes to growth. So when you look at the shape of the Eurodollar futures curve, it actually tells you something about the future often. So right now we have an inverted curve, which basically means that the market expects the dollar LIBOR interest rate to go up initially over the next, say, 3, 4, 5 months. And then the market expects that same dollar LIBOR interest rate to drop back again during the early parts of the spring next year, and basically throughout the remainder of 2023. So what that tells you is, first of all, that the market expects the Federal Reserve to turn around, to pivot, basically. But secondly, it also tells you something about the market's view on liquidity in dollars over the coming 3, 4, 5 quarters.
Right.
Because usually what happens when the dollar curve, the Eurodollar curve inverts, is that we see a higher potential or higher risk for a so-called liquidity event upcoming. And I think we have the early warning signals across the board in terms of dollar liquidity again. If you look at liquidity in bond markets, it's looking absolutely mediocre already. If you look at liquidity across other asset classes, we already see the early warning signals as well. And the Eurodollar curve is basically the first curve that tells you so.
What would be a good example of a liquidity event?
Well, if you look at so-called repo markets, we have weekly statistics from all of the primary dealers of US Treasuries. Right. And when there is a rise in the amount of fails to deliver in terms of bonds that you've used as the collateral in repurchase agreements, then I would consider that a firm liquidity event. And right now we have a rising amount of fails to deliver week after week in these primary dealer statistics. So that is, to me, an early warning signal that we actually already have a liquidity event. The ultimate end game of a liquidity event is what I call a dash for dollar cash. We saw such a move right after the early lockdowns in March 2020. Basically, right about every asset class sold off except for dollar cash, right? And that's, I guess, the ultimate risk scenario again here, that we end up in a dash for cash scenario and then the Fed will pivot.
Yeah, you were even talking about that with Groman. And even Groman, who is notoriously a dollar bear, said that if the Fed continues to raise rates, I think he used the term weaponizing, the Treasury weaponizing the Fed, that the only thing that you'd want to own are dollars. And this is from a long-term bear for sure.
Yeah. It's basically one of the few things that I want to own right now. I've been long dollar for quite a while. I'm born and raised in Europe, so I mean, I can even gain from it versus the euro, right? So right now, I mean, it's the only light that I have at the end of the tunnel because I earn a lot of my income in dollars and I pay my bills in euros. So that's a pretty decent hedge against what's going on.
Let's drill down on that a little bit further, because people, especially Americans, they always ask the question, well, who on earth would buy a treasury right now? Like, who in their right mind would get paid 3% to own a 10-year when the rate of CPI, as the government admits to, is 9.1%. And I'm like, okay, that's one view, but you also have to look at it from the standpoint of people whose expenses are not denominated in dollars, whose expenses are denominated in yen or in euros, or in my case right now, in Colombian pesos. And for those people, they don't really care about the CPI in the United States because that's just your purchasing power. So I guess my question would be, when you're setting up your own portfolio, do you care about the CPI in the United States, or to what degree do you care about it and why?
I only care about it because it matters for the Federal Reserve outlook, but otherwise it doesn't really matter to me. So you're absolutely right that foreign buyers of U.S. Treasuries, they don't necessarily care too much about the level of the CPI. They care about the Fed outlook, and I mean, it's been pretty visible that the Fed is not super serious about inflation, right? Even though we have inflation running at almost double-digit growth rates, they only like partially react to it. I mean, that's been my base case throughout this year. I've been wrong about the level of inflation that we would reach, but I kept saying that they would not make a big move in the direction of higher nominal interest rates. I mean, they've made a move, but we're back to like square one before COVID, and we have a completely different scenario for inflation, right? So the base case has been, from my side, all the way through this, that real interest rates will remain negative. I think it's the only way to get us out of this debt mess that we're in the midst of. And therefore, that is basically the equation I need to look at when buying a treasury from abroad. If the Federal Reserve only reacts partially to inflation, then it could be a good buy, even from such an equation seen from abroad.